Welcome, ladies and gentlemen, to Lesson 7, Accounts Receivable, Bad Debt Expense, and Allowance for Doubtful Accounts, and Notes Receivables. Alright, I recommend you go back if you have some 1, 2, 3, and 4. Because there we cover what a journal entry is, how to record a transaction, how to enter a transaction into a T account, from a T account, how we get a trial balance, from a trial balance, how we get to an adjusted trial balance, from an adjusted trial balance, how do we get financial statements, from after financial statements, post-closing entry and the post-closing trial balance. All those concepts and ideas are essential to Lesson 7 because obviously we're looking at specific transactions in accounts receivable, bad debt, and allowance, and those concepts are going to carry forward, and we're going to need to know those to get into these. Now, that being said, accounts receivable, these problems are the problems I want to walk you through, the journal entries I want to walk you through. These are applicable to all transactions. Now, okay, I'm going to run through these pretty fast, but you can use these transactions for your homework, for your tests, anything to do with accounts receivable, bad debt expense, and allowance for doubtful accounts, and notes receivables. Take this information, change the numbers, switch it around, same concept, but you'll have the solutions, right? That's why this is called a cheat sheet. You're going to have the solutions to any problems, to your homework, or tests that you're going to have. They're all going to be right here. Alright, that being said, start, right? Remember, start from Lesson 2, Lesson 3, Lesson 4. That's going to follow us through. Keep that as a framework. Accounting's easy. Did a transaction occur? What accounts? Record a journal entry. And the T accounts. Those are going to follow us all the way through. Mainly, though, we're just going to be identifying the accounts, recording the journal entry, and then entering into the T account from in Lesson 7. Alright, so let's get into it. So we're going to start out by covering some concepts and definitions. First, I'm going to read these concepts and definitions just so I get the right information to you. Also, these are on your flashcards. You can go through these, memorize what these means. These may show up on your tests or exams, or you may just want to know them. I don't know. But I'm just going to read through these. We're going to understand these concepts, then we're going to move through to some transactions. Alright, accounts receivable. Accounts receivable are amounts owed by other companies or persons for cash, goods, or services rendered by the company to those persons in exchange for cash. They're going to give it to us. Alright, open accounts owed to the business by trade customers. Basically, that's what it is. Alright, extending credit. Extending credit is likely to increase sales, but not without a cost. Those costs are bad debt costs, delayed receipt of cash, increased employee costs to manage receivables. Right, why do we extend credit? You want to make a sale to a customer. That customer wants to get those products and then turn around and sell it to somebody else. But that transaction that they make may take a little bit of time. You know, they want to get that inventory, sell it to get cash. Once they get that cash, they turn around and give it to you. So they want credit terms. They want to extend the payment cycle so that they can make that sale, receive the cash from their customer, and then give that cash back to you. That's why we extend credit. That's why we give people credit terms. That's typically why we have accounts receivable. It's because we're waiting for that customer to make that other sale before they can pay us. Okay, but it comes with a cost. We just cover those costs. Now, most businesses record an estimate of the bad debt expense by an adjusting entry, an accrual entry, right? Going back to Lesson 4, closing entry, determine at the end of the period what our bad debt expense is going to be for that period. Specifically that period, matching principle, we need to record it in that period. Closing entry, accrual entry, we're going to decrease an asset and increase an expense, right? Decrease asset, increase expense, that's an accrual entry. So what we're going to do here, so I'll read this definition. Most businesses record an estimate of the bad debt expense by an adjusting journal entry at the end of the accounting period, accrual type adjustment. The allowance method of accounting for bad debts, right? It's the matching principle. You record in the same accounting period your estimate for bad debt expense. In the same period you recorded the revenue, matching expense with revenue, matching principle. Sales revenue, bad debt expense, right? We're matching those two. Alright, what can happen if you underestimate your bad debt expense? Well, your net income is going to be up because you say you have revenue, but you're not recognizing that expense. Remember the income statement equation, revenues minus expenses? Well, if you don't include that expense, your revenues minus expenses, your net income is going to be higher. So you want to make sure that you're recording in the same period so you don't have high net income. Alright, net receivables on the balance sheet. So your receivables could look higher, right? If you're not recording the expense, so the journal entry is debit expense, credit contra asset, which is your allowance for doubtful accounts, contra asset. If you go back to your chart of accounts in Lesson 2, on the balance, when you go through your chart of accounts, right below accounts receivable is this contra asset account called allowance for doubtful accounts. A contra asset account is a separate account, but it decreases an asset, right? Contra asset decreasing against the asset. It decreases that asset, contra asset account. So the allowance for doubtful accounts shows up on the balance sheet, but it's a contra asset account. It's a credit. Most of the other accounts on the asset side are debits, but it's a credit that shows up in your asset because it's reducing one of the assets. It's reducing accounts receivable. All right. So there's two methods for estimating bad debts: percentage of credit sales or aging of accounts receivable. Percentage of credit sales, your bad debt percentage is based on actual uncollectible accounts from prior year's credit sales. So your percentage of credit sales is based on your actual uncollectible amounts, right? So you're basing a percentage of your current sales to come up with a bad debt based on your previous experience of percentage of uncollected accounts. We'll go through a problem just so that concept's clear. Definitions here. Definition will be in your flashcards. Aging of accounts receivable focuses on determining the desired balance in the allowance for doubtful accounts on the balance sheet. So aging of accounts receivable, we're going to go through a problem, but basically, like I said, these customers, you extend them credit because they're going to turn around, sell to somebody else, and they're going to get that cash, they're going to get that cash to pay to you. Well, what happens if they can't find any customers to buy that product? Well, then that life cycle, the time it takes for them to turn around and pay you is going to be long, and that's called the aging process, the aging of your accounts receivable. We're going to walk through a problem, but the longer that age is, the more likely you're not going to collect it. Just like when you lend your buddy $5, you see him next week, you say, "You got my $5?" He says, "No." Next week, you see him next week, he doesn't have it. He says the following week, you see him the following week, he doesn't have it. The more time that takes, the less likely you're going to get that money back. Same with a company. Now, quickly, we're going to discuss what a note receivable is. A note receivable is a written contract to pay a specific amount at a specific rate of interest at some specific future date. Kind of the opposite of a note payable. You remember back in lesson 2, Roundbelly entered into an agreement with a financial institution, and they got a note payable in exchange for 25 grand. Well, say Roundbelly did that to somebody else. It didn't. You don't have to just borrow from financial institutions. You can borrow from companies. You can borrow from people. So, say Roundbelly wants to lend money to somebody. Well, they're going to enter into a note receivable because it's a receivable to them. They're going to get money. So that's an exchange of assets, right? They give them cash, so they record an asset. They're going to get that money back plus interest. They're going to accrue interest as they go. As an accrual entry, go back to lesson 3, accrual adjustments. So that's note receivables. We're going to do a problem for note receivables in a second. Down here at the bottom of the concept and definition box, you'll see a note. Accounts receivable are shown net on the balance sheet, similar to machinery and equipment. And what does that mean, shown net? Okay, so accounts receivable, going back to the chart of accounts from lesson 2, you got your accounts receivable balance, and you say, okay, if that's my accounts receivable, let's just call that the gross balance, and then my allowance for doubtful accounts, that's my contra asset account. When I add those two together, that's my net balance, right? So that's how I'm going to show it on the balance sheet, net of my allowance for doubtful accounts. I'll show you how to do that transaction here and how it looks, or show you how to do that calculation and then how it looks on the balance sheet in a second. Now, let's get into some problems. Number 1, recording a bad debt allowance. Now, I'm just going to give you some givens. We're going to come up with the accounts, we're going to come up with the entry, and then just move on to another. Alright, here we go. Recording bad debt allowance. Roundbelly estimated bad debt expense of $50. Prepare the journal entry. Easy enough. This is an accrual entry, right? We would do this at month close or quarter close or year close, right? Just like in lesson 4, this is a closing entry. We know that we're probably not going to collect all these receivables. It comes with a cost, you see right here. So we need to estimate what that's going to be. So this is an accrual entry, so it's going to be a bad debt expense. So for increasing the expense, we're going to need to increase the liability. But wait, it's a contra asset account. Same thing. It's a liability. So increase the expense, increase the liability, debit bad debt expense, credit your allowance for doubtful accounts. Contra asset account, you'll see here in the parentheses of plus XA, that's contra asset account, and you'll see up here bad debt expense plus equity, or plus expense equals minus stockholders' equity. That gets back into our chain of events, or that flow chart in lesson 3 where we say how do we get from expense to our stockholders' equity. All right, that's what that in that parentheses means. All right, moving on. Number 2, writing off an accounts receivable. Now, I'm going through these because these are probably going to be problems that you get in your homework or in your exam. All you have to do is say, oh, okay, well, I already know the concept of this. The numbers probably changed, but all I need to do is plug it in this transaction, and I'll have the answer, right? Okay, so say the problem is writing off an accounts receivable. Roundbelly identified a receivable of $30 that was to be written off. Prepare the journal entry. Okay, written off. This is different from a bad debt expense, right? Because bad debt expense is kind of an estimate. We're saying, I think this is going to happen in the future. Well, now we're saying it did happen. We're no longer going to get that from that customer. Just forget about it. Write it off. I want to remove it from history. Well, how do we do that? We debit the allowance for doubtful accounts, and we credit the accounts receivable. So debit the allowance for doubtful accounts, credit the accounts receivable. That kind of just washes, allowance for